Hello everybody, it's Larry East with your mortgage rate update for the week of September 4th. It was a holiday shortened week this week since we had the Labor Day holiday on Monday, but we did get a big report. We got the unemployment report for August out this week. This report always has the potential to move the markets in big directions either way. This week was no exception. We got, let's look at a little bit at the report. As far as jobs created, this was for August, 201,000 jobs were created, which is a great number. Unemployment rate remains steady at 3.9%, an extremely low level of employment. So the job market is doing well. We're creating jobs and we have a low unemployment rate. The part of the report that was unfavorable for bonds and mortgage rates was the average hourly earnings. That's a component that is used to measure the inflation or is inflationary for our economy. This shows how much how much wages increase. This report showed since last August, rates have increased almost 3%, 2.9% wage increase from last August on a year-over-year basis. That's the highest rate since 2009. That's what spooked the markets because with wages increasing like that, it's definitely inflationary for our economy, and bonds are, inflation, as we've spoken about, is the enemy of bonds, and any signs of inflation possibly increasing, bonds are going to increase, mortgage rates are going to increase to try to outpace that inflation. Since the bonds and mortgage rates are a fixed rate of return for investors, they're always trying to beat inflation. So September is interesting because it's generally a month that we see an increased amount of volatility for mortgage rates, and that could be volatility with rates increasing or decreasing. A lot of it, I think, has to do with the summer holidays being over. Trading desks and traders have been having holidays and taking vacations, so they've had a very light staff. Now everybody's kind of getting back to work, and it just tends to cause volatility in either direction. Unfortunately, this week we saw rates increase. In housing news, CoreLogic, the home price index for CoreLogic, this was for the month of July. Now this measures home price appreciation. It showed, this is a national level, showed 6.2% home price appreciation for July, which by itself, good number. Over 6% home price appreciation is great. Now this is looking year over year, so that would be since last year. Now this number was slightly lower than the last 2 months. In June, we were at 6.8% appreciation. May, we were at 7.1% appreciation. So it appears what we're seeing is the house price appreciation slowing down month after month. And CoreLogic does a forecast for future home price appreciation. So they say, hey, in the next 12 months, now this forecast remained stable over these months, and they're at 5.1%. So they're forecasting a little over 5% appreciation for the following 12 months, which is a great rate of appreciation. We've had wonderful appreciation, and at some point those levels have to level off as house prices just grow too quickly. So it looks like that might be what's happening. We're not seeing decreases necessarily, but we're seeing that home price appreciation taper slightly. That's the bulletin for this week. Thank you very much for watching. Thank you very much for your feedback. If you need anything, I'm here to help.